Welcome everyone, and thank you for attending today's webinar, which is being recorded for your own information. Our speaker today is Alex Brandreth, who's the Chief Investment Officer from Lunar Investment Management. Alex will be looking at the current economic situation both in the UK and globally. He'll also be providing a valuable insight into the future of the UK and beyond. Today, the main topics Alex will be covering are the impacts of COVID and how it continues to affect the global economy, inflation, which is quite topical this morning with the information about inflation being 3.1% for September. And is this a temporary surge or something a little bit more structural? The impact that higher growth and inflation is having on the markets and where best to invest, and how recent changes by the Chinese authorities will impact the markets. We'll be taking questions at the end of the presentation, or if you prefer, you can submit these via the chat box, which is on screen down at the bottom. We expect the webinar to last between 40 and 45 minutes. Just from Pareto's point of view, the autumn budget is due out on the 27th of October, and will set out the next stage of the government's plan to build back better, or if anyone's seen any of the emojis going around, build back biscuits with Boris Johnson. It is rumoured that this will be a so-called technical budget, which Rishi Sunak has said will aim to continue to invest in public services and drive growth, whilst keeping public finances on a stable path. However, with the UK national debt being over £2 trillion, the pandemic still causing uncertainty and the end of the furlough scheme, it's true to say the Chancellor is facing a huge challenge to provide the country with another financial boost to sustain public spending and protect the fragile growth we've seen so far in the UK economy. Pareto will be sending out our usual commentary in the days that following the budget, and as usual we'll be highlighting the salient points that will impact clients, introducers, and also our introducers' clients. So without further ado, I'll pass you over to Lunar's Chief Investment Officer, Alex Brandreth, to run through the presentation. Thank you, Alex.
Thanks, Stuart, and good morning, everyone. Thanks for all your time today and for dialing in. Thank you to Pareto as well for organising this event. We haven't done one for a while, but when we do try to do one, we try and keep it as topical as possible. And as Stuart said, there seems to be a lot of moving parts at the moment, whether that be inflation, central bank meetings, and obviously COVID and the backdrop that we continue to live in. So in terms of what we'll go through today, give a quick introduction to Lunar and a reminder to those of you who have come across us. We'll go through the COVID backdrop, not just in the UK, but globally. I think it's just important to see what's going on globally. 70% of the earnings that come into the FTSE 100 are derived from outside the UK. So it's incredibly important from a UK investment perspective, and when you're investing in the UK stock market, to understand what's going on globally as much as what's going on more locally in the UK. We'll touch on how that's impacted global growth and it's likely to impact global growth. As we've already said, inflation data is out today, so it's quite timely for us to be doing this presentation. So we'll just touch on that, and also the consequences that has when investing. We've just literally gone through the third quarter, so we'll touch on the main events that happened during that quarter. But more importantly for us, yes, it's interesting to see what's happened, but it's equally just as important to see what's going to happen, and that's what we do at Lunar when we're investing. Is we're looking forwards and not always looking backward on what has happened. So to introduce Lunar, then. We started the business 18 months or so ago in the middle of the pandemic. We were an appointed representative of a firm called Thornbridge Investment Management. Thornbridge give us support in terms of compliance. It also was a very quick way for us to get regulatory approval, so it was necessary. We will be going directly authorised with the FCA in the future. What do? We offer discretionary investment management services. That means that we can make decisions on portfolios without having to ask questions to yourself and ask for permission to do that. So if we decide one day that we want to sell, I don't know, EasyJet and buy Rio Tinto, for example, we can take that decision on your behalf. We are based in Manchester, but we service clients throughout the whole of the UK. And despite the fact that we are I wouldn't say new anymore, despite the fact that we've been going for 18 months or so. We do have a lot of grey hairs within the team, a huge amount of experience across portfolio management, research, etc. And you can see that 185 years. That's not just me. What do we offer? We offer a range of services, bespoke portfolios, taking into account your individual needs and requirements to build a portfolio that's suitable and appropriate just for you. Model portfolio service on external platforms where you would access us via somewhere like Standard Life. And equally as important from an inheritance tax planning perspective is name portfolio, which means if you're buying AIM shares, that after 2 years of holding those companies, that they qualify for business property relief, which means they're outside your estate, which is a very common inheritance tax planning tool that we offer only through financial advisors and Pareto as well. Despite the fact that we've only been going for 18 months, we've also attracted a number of awards recently. The MPS award on the left there was given in the summer, so we're delighted with that. We'd already been given the expert rated by De Facto earlier on in the year. And De Facto look at the business, our services in a number of different ways. They look at the systems that we offer, they look at the people, they look at the costs, they look at the process. It's very detailed in terms of the approach they have, and we're delighted to be recognised by De Facto for both two of our core offerings. So that's enough about us. Let's go into what's going on in the world. So this slide here on the top half looks at the number of individuals that have tested positive for COVID. It goes all the way back to when this all started in early January 2020, and it's relatively up to date, and it goes up to the end of September. Clearly, it's a fast-moving beast, but it's relatively up to date here as well. Now, there's a few points that I'd like to highlight on this. Clearly, as we know, COVID was accelerating throughout 2020. That being said, testing was also ramping up dramatically through 2020 as well. So we really don't know the exact situation that we would have been in March. And as you can see, on the bottom half of this chart, it's sadly the people that have died because of COVID, which is standing globally at just under 5 million. But you can see there that it does follow a relatively similar picture. As we know, there's a slight delay from people contracting COVID to sadly passing away from it. But there has been 3 distinct waves. The wave throughout the course of last year, there was the Delta variant wave, which was rampant earlier on in the spring. And then more recently, there's definitely been a pickup in COVID cases. More recently, though, again, it's positive signs in that globally the number of cases are starting to decline. And crucially as well, what we've noticed here is that the number of people that have sadly died from COVID hasn't increased to the same extent that you've seen in previous waves. So here you can see the amount of people daily getting confirmed cases was quite high, and that was followed by, shortly after, a high number of deaths. And equally here again in the springtime, that was coming through as well. But in this summer wave, you've not seen that pick up to the same extent. And we know the reason for that, and that's clearly the successful vaccination drive that's going on globally, not just in the UK. And here, this just looks at the data from when vaccination started and looking at different nations and how they've performed in their vaccination rollout. So there's a few different countries on here. Israel is the poster child for vaccination rollout. Clearly, they have a smaller population, but they have been one of the quickest growing and quickest nations in terms of rolling out the vaccine. And you can see how successful they were in the spring in doing so. And there's a lot of attention that needs to be paid on Israel, because it's also very interesting to figure out, well, is the link between COVID broken in terms of having a confirmed case to being hospitalised and then sadly dying. And that's something that we're consistently looking at now because of the situation we're on in terms of vaccination efficacy as well. The UK and US are in this blue and green line, and as we know, we're very quick out the block in terms of their vaccination rollout. You can see the US has lagged a little bit more recently. Sorry, I should have said that this is cumulative doses per 100 residents. So the 100 line there means that at least one person has had a vaccination. Israel is over 160, which suggests that, as we know, that they've not just had one vaccination, but they've had the second dose as well. The UK currently is sitting at 140. So the stats for the UK is that 79% of individuals have had one dose and 73% have had two doses. And clearly, this data is from the 6th of October. It doesn't take into account the booster rollout that's going on at the moment, but that's clearly happening and having an impact in terms of doses as well. So that the UK and US were very quick and in terms of their vaccination rollout. China and the rest of the world then caught up very quickly throughout the summer. You see China as that red line, and it really accelerated per 100 residents to overtake the UK and Canada. The EU, clearly it's been very political with regards to what's happened there in vaccination supply, but the EU did have a very good summer in terms of their vaccination rollout programme. But that being said, it's not been great, and it's not been rolled out as efficiently as it can do everywhere. We've got India on there, which is clearly a very big population and has lagged in terms of their vaccination rollout. And in terms of where we are globally at the moment, there's been 48% of the global population which has been given one dose, and 36% of individuals have been given second dose. So there's clearly significant rollout to come over the course of this year and throughout next year to vaccinate the world. So what does this mean in terms of global growth? This is data from the OECD, which shows the expectations for 2021 and 2022, and there's a selective number of countries on here. I think the first thing to point out is 2021 is going to be a record-breaking year for global growth. The world is going to grow by 5.7% in 2021, and there's a number of reasons for that. One, 2020 was clearly a horrendous year and broke records for all the wrong reasons. So there has been a bounce back, and we are going through a very much a V-shaped recovery at the moment in terms of economic growth. That has also been triggered by the fact that gradually, we saw it more gradually throughout the UK in the summer, but gradually across the world now, you're seeing economies starting to reopen. And as economies start to reopen, consumers go out to spend, that has a significant impact on global growth. You know, we are a consumption-based economy, global economy, which drives global growth. So that's one of the key drivers to global growth being stronger this year. But as we show on this chart, it's not just a 2021 impact, it's very much going to be a rollover to 2022, because some countries are still reopening. And we touched on India on a previous slide. India has grown very strongly this year, but is expected to be one of the fastest growing nations next year as their vaccination programs really roll out and restrictions can be eased further and further. In terms of what matters globally, the two superpowers matter globally, China and the US. You can see China at the top of the leaderboard there in terms of expectations for 2021. But 2022 is going to be a very strong year for China as well in terms of growth. China does tend to grow significantly quicker than other global economies. The US, though, the stats for the US look very promising as well. 6% growth in 2021, followed by 3.9% next year. And just to put those numbers into some context, the US, when performing in a normal environment, would it be expected to grow by about 3% per annum. So you can see that this year is going to be double what you'd expect to see in a normal year, but next year is also likely to be strong in terms of US growth as well. Bringing it closer to home, the UK is performing very strongly at the moment. That's been key to the vaccination programme and lifting restrictions as quickly as they can. You can see the UK is expected to be very strong this year and very strong for 2022. Putting those numbers in context, the UK during good times is expected to grow by 2%. So you can see that the UK growth this year and next year is likely to be significantly stronger. But back to the reasons we touched on, this is coming back from a very low base in terms of what happened in 2020, sorry. Now, what's driving that growth? There's three principal drivers for that growth. We've already touched on consumption. corporate expenditure is very high, and government support is still there as well. So they're the three key drivers behind what's driving global growth, and we're just going to go through a few of them here. So the first is in terms of corporate strength. On the left-hand side, you can see two lines. The grey line, which shows the amount of business investment that's been going on within the US, just purely just the US, but also what CEOs, what business management are saying in terms of what they plan to do for the future in terms of CapEx intentions as well. And you can see there, back to what I said earlier, this is very much a V-shaped recovery, because those lines right at the end of that chart are both moving very high very quickly, and corporates have come through COVID, I would say in general very strong. There's obviously a few sectors that have been more exposed, whether it be the hospitality or airline industry, but in general companies are in very strong situation in terms of the amount of cash that they have on their balance sheet, the amount of government support they've been given to be able to continue to operate in this environment. And they've also been able to take a significant amount of costs out and really examine how well their businesses can run through COVID. So business investment and looking forward in terms of capital expenditure are coming back very strongly. But how does that look relative to other cycles? And that's where we move to the right-hand side. And this shows the three previous recessions that we've had, the current cycle in purple, the dot-com boom in 2000s in that light blue, and then the global financial crisis in 2007, 2008. And you can see that the bounce back within this current cycle has been a lot stronger than in other cycles. And there's probably a few reasons for that. One is the fact that we were going into this situation right at the beginning of this chart in slightly healthier situation. So we hadn't been running business investment to the same extent at the levels that we had before the global financial crisis. Two, I think the issue with the financial crisis and the catalyst behind it was a banking crisis, and we needed to repair the banking system, which took a very long period of time. And the banking system's key in terms of financing the economy. This time round, it's been very interesting that you've seen absolutely zero comments about any banks being under pressure, because of the fact that we've been repairing the banks for 10 years or so since the financial crisis now. So banks are willing to lend, banks are very supportive, and it's been able to help support the fact that the economy's rebounded. On top of that as well, it has been a slightly odd recession in that most people actually feel wealthier coming through the cycle, which means that businesses have got the confidence to go out and start to invest for the future. We haven't had that in the past. Normally, you feel less wealthy when you're going through a recession, but in fact, it's been completely the opposite this time around, because of the fact you've had significant support by governments, and central banks were very quick in terms of cutting interest rates and starting quantitative easing as well. So, big tick. Corporate balance sheets are very strong and are looking to spend as well. However, as I said, within the UK and the Western world, consumers drive economies. So it's roughly 70% of the UK economy is driven by the UK consumer. And one of the big positives, if you can call it a positive, from COVID was the fact that we couldn't go out and spend. So what have we all done? We've all hoarded cash, we've all paid down debt, we've all increased our mortgage repayments, and that's put the consumer in a very healthy situation. And that's not just the UK, as you can see in this blue chart, it's also the case within the US and Eurozone. In the US as well, they were actually being sent stimulus checks straight into people's bank accounts for them to go out and spend, because the US is so much consumption driven that they wanted the consumer to be in a healthy situation throughout this. So the consumer, the general public, is in a very healthy situation in terms of savings after the pandemic. And as we touched on the previous slide, companies are in a very strong situation as well. And you've seen a record number of vacancies for jobs. There's probably a few reasons for this. Back to what we said earlier on the previous slide, corporates are in a very healthy situation and they're looking to increase production and increase supply what they produce. So that means that they are looking to hire quicker than they ever have done. And some of the numbers here are pretty high. On top of that as well, you have seen, because of COVID, a number of people leave the workforce, which means that the number of people working is at a low at the moment compared to where it has been historically. And why is that the case? Well, people have had to leave their jobs for childcare reasons. People have left their job or taken early retirement because they've realised lifestyle-wise that they can afford to do that in this environment. So because of that, you've seen people leaving employment, which has meant that job vacancies are pushing through. On top of the fact that you've got corporates which are willing to spend at the moment as well. So bringing it back home, what does that mean from a UK perspective? Two charts on here. This touches on UK unemployment rate. You can see that the COVID recession, you didn't see unemployment rate move anywhere near the levels that you've seen historically when we've had a recession. Back in the early 90s, unemployment reached 11%. During the financial crisis, it was touching 9%. Whereas during COVID, it hit 5%, and as you can see, has already started to fall. And one of the key drivers behind that is on the right-hand section of this chart, furlough. So furlough has been a very key support in terms of keeping the unemployment rate low. But as we know, it's been gradually reduced over the course of the summer, and it's now been officially stopped at the end of September. But you can see here that the amount of people on furlough has fallen dramatically. During the peak of COVID last year, you had 35% of private sector employees taking furlough support. That picked up during the restrictions over the winter, but gradually has been falling more and more, and will now go to zero because of the fact that it no longer exists. So what does that mean? That means that you could temporarily see a small increase to unemployment as those individuals go through from being on furlough and now unemployed. You could easily see people returning back to work. But equally, as we said on the previous slide, you could see people taking different jobs as well, because there is record number of vacancies in terms of employment within the UK as well. So furlough does create a bit of a concern to some. It doesn't to me for a few reasons. One, unemployment has been kept low throughout this economic cycle anyway. And when it does come back, it's not going to spike to the levels that it has done previously. So we're very confident and comfortable with the employment situation within the UK, despite the fact that furloughs come to an end. Inflation. I mean, the joys of putting these slides together, as soon as you put them together, they're out of date because of the data that we've had this morning. So what's the data that we've had this morning? We've had CPI come in at 3.1%, which is a fraction lower than this number here in August, which was 3.2. Why has it come down? Forecast from an economic perspective, because you're looking at the prices today and you're looking back to where they were a year ago. And when we look back to where we were a year ago, we had the Eat Out to Help Out scheme, which was helping to keep prices slightly lower. That was having an impact in the previous numbers, but has now rolled out of the numbers that we've had. So that's one of the reasons why inflation's dipped slightly today. What about over the coming months though? My view, the Bank of England's view, is that inflation is going to continue to pick up through the winter. You've seen increase in energy prices more recently, and as we had on the previous chart as well, you are starting to see some wage inflation coming through as well, and we'll come back to wage inflation because that's very important when thinking about inflation for the long term. So why is inflation higher? I mean, the reason we have this chart going back to 2011 is to look what happened at the end of the global financial crisis, which is the last recession that we had. And you can see that CPI at the time, no one really remembers it, but got back to 5%. It's very possible that CPI can get back to 5% over the next few months. When you're coming out of recession, demand is strong, it tends to be an inflationary environment. And you can see that we were coming from a very low base in terms of the impact that inflation was having last year. And if we did showed you charts going back to 2008, we actually had a little bit of deflation in the UK back in 2008 because of what's going on in the financial crisis. So it's very normal at this time of the cycle to see high levels of inflation. Why is that coming through? We all know about the increase in gas prices within the UK. Wage inflation is coming through. Petrol prices are coming up. Shipping costs, because of the impact of COVID that's had on the global supply chain, is pushing shipping costs higher. Interestingly, though, that is now starting to impact some corporates. So Boohoo and then ASOS a week or two ago have both highlighted rising costs when they reported. I think there's a tendency at the moment to think this is just going on within the UK. It's not. Shipping costs are global. Other countries are going through the exact same thing in terms of this demand side bounce. At the same time, when supply is very limited and being impacted by COVID. So it's not just happening within the UK. US inflation is running at 5% annualized at the moment, so currently higher than the UK. And as we've touched on here, Germany, which is tends to be a lower inflationary environment in the EU, is also going through very high levels of inflation at the moment. So it is very topical. We've got the Bank of England meeting in a couple of weeks. And if you asked me this a couple of weeks ago, I probably wouldn't have agreed with it, but do I think interest rates are going higher? Probably. And I don't think interest rates are going higher because gas prices are going higher or petrol prices are going higher. I think interest rates are going to go higher because of the fact that you've got wage inflation going higher. And wage inflation is really key to longer term inflation. A lot of what we have at the moment is bouncing from the lows that we saw in last year when we were technically in lockdown. So you'd expect inflation to be higher. But as we progress and as we move into early next year, those impacts will start to reduce. And the Bank of England have already looked through a lot of that and expect that to happen as well. But I think what surprised them has been this increase in energy prices and then this increase in wage inflation as well. So I think that's why you'll start to see interest rates going higher in November. And we talk about going higher, it's going to go from 0.1% to 0.25%. So let's put this in context. And inflation, interest rates going higher as well is also a good sign that they think the UK economy is performing very strongly and is surprisingly upside from the COVID bounce that we've had this year as well. But what does that mean when you're investing? That's the key question for us at Luna. And as we touched on, in UK consumer price inflation is now at 3.1. Retail price inflation actually increased this morning. That went up to 4.9%. So what do you do when you're investing? Interest rates within the UK are currently 0.1%. As I said, they might increase to 0.25% in November, and I think that's starting to look likely. So that's a big gap between the level of inflation and interest rates. And the best way to think about this is almost a tax on your savings, because everything that we own and buy has just increased by 3%. Whereas if you're just holding money in the bank and you're receiving the Bank of England interest rate, then you've lost out by about 3% over the last year if you're looking at consumer price inflation, and then nearly 5% when you're looking at retail price inflation, which is a very big gap. So what do you do in terms of investment? Well, you could go and buy a government bond, but government bond yields are at the lowest levels they've been ever. And that's a function of the fact that interest rates are low, but quantitative easing is buying government bonds. So the central bank are buying their own government bonds, which pushes the price up. And as the price goes up with a government bond, that means the yield comes down. So government bonds, you're still going to deliver a negative return in real terms relative to inflation if investing there. So you could take a little bit more risk. You could go out and buy a corporate bond. So you're buying company debt like Tesco's or Marks and Spencer's, and you're investing with them. And you can get a very attractive return of around 2% at the moment. So again, you're struggling to deliver a positive return after inflation. So you can take a little bit more risk, and you can buy high yield bonds. What are high yield bonds? High yield bonds are companies where you have to take even more credit risk. So there are even smaller businesses where rating agencies like Standard & Poor's rate their debt even lower than they do from a high investment grade bank. but you take more risk because these companies have potentially more debt, they're more leveraged, they're smaller, and you're compensated by that by getting a slightly higher return. So 4.7% is not that bad when looking at it from an inflation perspective. If you want to take quite a lot of risk, you can buy emerging market bonds as well. So buying the debt, not of the UK government, but buying the debt of Chinese, Russian, Indian, Latin American countries, etc. And you do get compensated quite well for that at the moment. But as we know, and we've been seeing this in the past, that those countries can default, and that means that that you're not going to get all the money back that you initially invest. But you can deliver quite a decent return if you're selective in terms of the emerging market countries that you buy. I think it's also important not just to look at what's going on in the bond market, but what's also going on in the equity market. The FTSE All-Share at the moment has a yield of just over 3%, which is quite attractive relative to other asset classes. Unlike bonds as well, dividends can grow over time. And this level is quite depressed compared to where we were 18 months or so ago, because you saw a significant amount of dividend cuts through COVID. It wasn't very fashionable and trendy to be increasing and paying dividends at the same time that you're taking money from the government. So this is relatively low, but is now starting to increase. We've started to see a number of special dividends being paid, companies returning to the dividend paying roster, because they've, as I said, right at the beginning, gone through COVID and have come through this significantly better than they thought they were a year or so ago. We don't just invest in the UK, we invest globally. If you want to invest in the MSCI World, you can still get a yield of 1.7%. That is dominated by the US. The US market's around 60% of the MSCI World and does tend to be quite a low dividend paying market. So again, if you are looking for income, you can get a small dividend yield from investing globally as well as the UK. And as I said, these numbers aren't fixed and they can grow over time. That was just a snapshot in time. This chart looks at what can happen when you compound inflation over a long period of time versus just putting money in the bank. And yes, I highlighted the fact that this is a very big discrepancy at the moment, and one of the widest that it's been for a very long period of time. But we're in a situation where interest rates have been kept low for 10 years now, since the financial crisis. And yes, interest rates did get to the dizzy heights of 0.75% just before COVID. But today they're at record lows. And even if they go back to 0.25%, they're still going to be relatively low compared to where they have been on history. And at the same time, it's not been in a high inflationary environment over the last 10 years, as we showed on that chart. I mean, we had high inflation back in 2011, but it's been quite flat in other periods. But when you compound time, that can have a significant impact on your wealth. So the difference between investing 100,000 in September 2011 meant that would be worth, in today's terms, 130,000 from an inflation adjusted perspective. But if you've just been sat on cash, you'd only have 105,000 nowadays, or nearly 106,000, which is a massive gap. And if anything, you can see here that that gap is starting to accelerate because of the fact inflation's really started to pick up. So the purpose of showing this chart is that I think this is probably the biggest risk for investors at the moment. A lot of people concentrate on what's going on in the equity market, but this is something that's been around for 10 years. Really, I don't think it's highlighted or talked enough about, and it's having a significant impact on people's day-to-day savings. So to me, this is the biggest risk. It's one of the reasons why we have a very low allocation towards cash within the Luna portfolio at the moment. So let's just take a step back. As I said, we've just come through the third quarter. This chart just shows how markets performed in that environment. On the left-hand side of this chart, you've got the FTSE 100. You've got the US market in that yellowy colour. You've got Europe in that light blue, which is, you just see. Japan, which is the strongest performing market in the third quarter. Japan was strong for a few reasons. One, Japan had been very weak through most of this year. So for the first 6 months, Japan hadn't really done anything. In fact, it had gone backwards. So Japan has bounced back very strongly and caught up with other global equity markets like the UK and US, which have done a lot better this year. As well as that, there was that feel-good factor after the Olympics that came through. And then more recently, the Prime Minister has stepped down as well. And his ratings were very poor in Japan because of the vaccination rollout as well. Excuse me a second. So that's been seen as a positive that he stepped down. On the flip side, it's been a very painful time to be invested in Asia, Hong Kong specifically. It's got the Hang Seng market here, where we've in a quarter, the market's fallen by 12%. And there's been a number of factors that have impacted the market in China specifically over the last quarter. The first was basically the privatization of the education sector. The Chinese authorities turned around to educational firms and basically turned them non-for-profit. And they've done that for a few reasons. One, China has had this one-child policy for a long period of time, and they're now trying to get families to have more children. And one of the feedback that they're receiving was it was too expensive to send their kids to school. So what did they do? The Chinese authorities turned around and basically turned the whole sector to non-for-profit very quickly. After that, you had more legislation and the authorities impacting the technology sector, which is a very important sector for the Chinese equity market. Similar to the US, it's 25% of the equity market is in technology, and some big technology players within that as well. And I think the Chinese authorities here were very surprised by the strength of the technology sector throughout 2020, and also potentially a bit worried about the power that they had as well. So they've looked to impose more restrictions, and in doing so impact the profitability of these businesses, which has a big impact because they're such big weights within the stock market. And then finally, as we've seen during the course of September, there's been concerns around Chinese property, and the Evergrande issue has been hitting the headlines. I think, again, this is just the Chinese authorities just trying to manage the population, manage their country in the best way that they think is appropriate. And that's had an impact in terms of speculation of the property market over the last year or so, which has meant that companies that have been running with high levels of debt have come under some pressure. So that has really, the impact of Chinese authorities on several layers have really impacted the equity market in the third quarter, and that's why investors have seen quite significant price falls. I think there's a few points to highlight here. The first is, fortunately at Luna, we're very much on that left-hand side with a bias towards the UK and US, and we can touch on that bias shortly. But it also just gives you a reminder of the risks when you're invested in emerging markets, and in China specifically. The authorities can turn around and do this at any time. So it's incredibly important to put this into context and be aware of this risk when investing in these regions as well. Now, this is only the third quarter, and it really doesn't tell the full story. In that it's been really a quarter of two halves. July and August were a very strong period for markets. There was a very strong stock market bounce, whereas September and early October, not so much the last couple of weeks, has been a little bit weaker for stock markets globally. And there's a few reasons for that. The first is we had the issues with regard to the US debt ceiling. The second, global investors are now waking up to the fact that central banks are starting to change their approach. In the UK, we've already touched on the fact that you see interest rates starting to rise from November. But in the US, they've also brought forward the end of quantitative easing. So they're going to start their tightening cycle as well, which is significant earlier than people expected to be. And the US central bank is seen as a good bellwether for what's going on globally. So it has important factors there, as well as the other risk factors that we mentioned with China as well. So there's been a few reasons why markets have been weak. And let's not forget the fact we've had a fantastic bounce since the middle of March last year, when the COVID low was. The S&P this year had 7 months of positive performance on the bounce, and we were probably due a correction, a bit of profit taking within markets as well. So it's very healthy to see this on a regular basis. It just means that animal spirits don't get too ahead of themselves. So just want to touch on where we are looking forward. This chart here just looks at the valuation of different asset classes. The first touches on government bonds. It looks at their own history versus 15 years. So you can see here the US Treasury, which is this very final bar on the left-hand side, is at 93%. Well, what does that mean? It means it's the one of the most expensive points that it's been at over the last 15 years. It was higher in the spring of this year, but government bond yields have sold off during the early summer, and then again more recently, because of the higher inflation that's coming through and the expectation that interest rates are going to start to move higher. So as we touched on, government bonds globally remain very expensive. That has a knock-on impact to corporate bonds, and that's this blue bars here. You can see different types of corporate bonds, whether they be emerging market debt, which looks slightly more attractive, or US corporate bonds. As you said though, and as we highlighted within the UK corporate bonds, it's not really an attractive place to be buying credit at the moment. Equities and different equity markets. The UK stands out to us, and that's why we've highlighted it here. The UK has been hated by overseas investors for 5 years or so because of Brexit. That's now had an impact where it's left the UK stock market looking different compared to other global peers. Japan looks quite attractive as well, but you can see the UK really stands out. And that's one of our reasons for having a bias towards the UK. That's starting to be noticed globally now. That's why you're seeing Morrison's getting bid for. UK stands out to private equity within the US and being very attractive. And if it's not private equity within the US, it's activist investors which are taking significant stakes in businesses to try and push valuations higher. Activist investors and private equity tend to take a slightly longer term view and are willing to look through short-term concerns, so are willing to buy into these valuation discount. And in terms of sterling as well, that's also cheap. So within the UK, you've almost got a double discount at the moment in buying the UK. That's very short term in terms of what we touched on for the third quarter. This is one of my favorite slides that I will always show within a presentation. And it just shows the different cycles that we go through, both the good times, the bull markets, but also the bad times in terms of when we have a bear market. The first point to highlight is the average bull market is around 6 years. Now, we started this bull market in March of last year, so we're kind of 18 months in, but you can see that it's still very early days in terms of this bull market. And who knows if this is going to be an average bull market, a long bull market, or a short bull market. But the signs are that this can go on for a longer period of time. The flip side, bear markets, you can see that this was in March of last year, was one of the quickest bear markets that we've ever had. In terms of the February and March falls were very severe, but were over and done with very quickly. So let's take a longer term perspective. We are in a new bull market. We have been in a new bull market for a while now. And you can see some of the returns that have happened historically when you've had a bull market, and we're nowhere near reaching those levels just yet. So there's reasons to be positive from investing in equities. Just quickly, there's a lot of talk about ESG investing within the industry, and we're getting more and more questions on it. So I thought it was important to have a slide on that today. So what does ESG stand for? It's looking for companies that take into account environmental, social, and governance. Social and governance really have been around for a very long period of time. The companies that we've invested in, we've always looked for independent boards, for example. We've looked for good management quality. So governance has always been a very important part of investing. This environmental factor has become heightened because of COVID and the fact that the climate change journey that we're on and the goals that we need to fulfill in the future. So it's becoming a growing part of the investment industry. And one of the ways that that's been impacted is the fact that you're seeing more and more regulation come this way over the last few years. So every time a company does a presentation to us today, and they're a listed company, they have to talk about how they satisfy ESG. So it's something that has to be reported at every single annual and semi-annual event. But it's only going one way. And you can see this by looking across the pond and looking at what's going on within the EU. The EU launched the Sustainable Finance Disclosure Regulation in April of this year. it's very possible that you'll see something within the UK as well. And that means that every single fund, every single unit trust that is launched within the EU now has to disclose how they tackle ESG from an investment perspective. So there's greater and greater emphasis being put on how to invest from an ESG perspective, which means that assets are moving that way. And you're starting to see that certain companies are awarded for having good ESG credentials than others. So that's an important factor, because that's driving share prices. And at the end of the day, we're buying businesses, and that's something we need to be mindful of. It was only last week when there was concerns about soybeans and the impact that that's having on deforestation. And that had a significant impact on markets. So it's happening all around us all the time. Now, what do we do at Luna? I mean, this is something that is not new. We've had it since we started the business. And again, back to the fact that we offer bespoke services, that's something that we take into account as well. And the other important criteria that we have at Luna is it's your portfolio, it's your money. What's important to you? You know, do you want to have a particular bias away from alcohol or tobacco as the obvious areas, or oil and gas companies? And that's very much what we do, and we take into account when building a portfolio. So be rest assured that if you are interested in that, please feel free to talk to us about it as well. As we have done with Thornbridge and other firms, we do partner with specialist firms to help support us provide these services. And an ethical screening, or a company that we found 2 years or so ago when we started, as a good outfit. We approached them for a few reasons. More recently, we asked them to do analysis on a particular company and asked them for their view on how we felt that the ESG factors were coming through. And it came through with a very detailed report in terms of what was positive and negative about that business. So I'm conscious of time and we've got questions. So I'm just going to quickly wrap up and I'll hand back over to Stuart. At this stage of the cycle, we still have a bias for equities. And that's also driven by the fact that we don't want to have an allocation, or we have a low allocation to fixed income and cash for the reasons I mentioned. At this point of the cycle as well, we think it's good to have a balance between areas across the market cap spectrum. So what do I mean by that? Having exposure to smaller companies, having exposure to larger companies. Smaller companies are very much more exposed to the economic cycle, so tend to perform better in this environment. But also from a style perspective, we can see the benefits of technology through COVID, but valuations in that part of the market do look quite rich. If you take in a longer term perspective, as we do, we're comfortable holding them. But you can definitely make a case for recovery type plays in this environment as well, where companies are coming back, they're coming back to life after COVID, and we want to have some exposure to there. So we're not biased to any one particular style at the moment. We have exposure to growth and technology, but we also have exposure to companies that can perform well as the economic cycle rebounds, as we've already seen. I think we made a good point for the UK here in terms of the valuation difference, and that's been noticed, as you said, by activist investors and private equity. Cash, very difficult to justify given the tax that is impacting from an inflation perspective, and also fixed income because of the very low yields on offer there. But important to us, we offer well-diversified, balanced portfolios. So we need to have some defensive assets in there, and that's where we're looking at alternatives at the moment to provide that support within portfolios. We also invest thematically. I don't want to go into too much detail, but you can see a few themes there in terms of global brands, the consumption story coming back, technology, the fact that we're so reliant on technology even more so than we ever have been, healthcare, and then we're also seeing a wave of infrastructure projects coming through globally. And finally, one of the most important points when investing with Luna, when discussing your investments with us, quality is always at the forefront of our mind and something we won't sacrifice on. We want to find good quality businesses, good quality fund managers that can drive long-term performance. And that's what we're concentrating on. So I'm going to hand back over to Stuart, and we've got some time for questions.
Great, Alex. Thank you for that. There's a couple of ways that you can ask questions. There's a chat box down the bottom, and there's a question that's come in via that. There's also a questions and answers box. And I've got a question that I'd like to ask you, Alex. So if we go to the first question, with regards to coming from Nigel Shaw, are higher interest rates a negative for equities in the next few years?
So it's a good question. If interest rates go higher, then that means that corporate debt levels in terms of the yield will potentially have to go higher. But I mean, we're talking about higher interest rates, but you know, what is high interest rates? We're going from 0.1 to 0.25%, which is not a significant increase really in the grand scheme of things. And at the top of the last cycle, we got to 0.75%. I really won't be surprised at the top of this cycle, it's something similar as well. Because central bank is almost on a tightrope at the moment. On one side, you've got this inflationary pressures that they're worried about, but on the other side, they don't want to choke off the economic recovery. So they're trying to have that balance. And I think it's really just a token gesture by the Bank of England in November to what they're looking to do. And then let's not forget, we also have a significant amount of debt at the moment. And if interest rates go dramatically higher, then that's going to have a big impact on the public finances within the UK as well. And every time that Rishi Sunak talks, he highlights that fact. There's almost a nod to the Bank of England to say, don't forget that you could be having a significant impact on the UK economy if you do push interest rates too high. So I don't think that, as I said, interest rates are going higher. They're not going to be back to the 5 or 6% that we saw back in 2007, 2006. And they're going to be very much similar to the levels that we saw at the peak just before COVID. And I don't think that's significant enough to choke off any economic recovery and cause concerns to the equity market in the short term. That being said, Stu, it's definitely causing volatility in the short term. And as central banks change and pivot from being in accommodative mode to start to tighten, that has always impacted markets, and that's exactly the environment that we're going through in September. So in the short term, it could cause a little wobble. Longer term, now we're looking through that volatility.
Another question that's come in from IFSA. Do you think the Bank of England is looking to increase interest rates because of the recent pickup of inflation? Easy for me to say. So do you think the Bank of England will look to increase interest rates because of the recent pickup of inflation?
Yeah, I think so. And as I said in the presentation, it's not the short-term one-off inflation that we're seeing, whether it be the oil price bouncing back from negative a year ago to where it is today. And you see it within the costs and goods of all commodities going up and up over the last year or so. I think that is just a one-off impact that happens at this time of the cycle. And we saw it in the last, as we were coming out of the last recession in 2007 to 2008, back to 2010. So inflation got to 5% then, and inflation can definitely get to 5% this time. But I think what the central bank is really starting to focus in on is higher energy costs and wage inflation, which are the two big changes that have happened over the summer, which I think have caught them not by surprise, but maybe off guard slightly. So yeah, I think that's the key reason why you'll see interest rates moving up in November. It's the 4th of November when the next Bank of England meeting is. And then, sorry, the other point why November matters is that the Bank of England only increase interest rates at one of their quarterly reports. And November's, it just happens to be when their next quarterly monetary report comes out. And if they didn't do it in November, they'd be doing it in February. And that's because that's the next time the quarterly report comes through. So there's reasons why it's likely to be in November as well.
Sorry, that was a different question. IFSA asked, do you think now is a good time to invest, which largely follows on with regards to the volatility, what you've been discussing? Yeah, again, I mean, it all matters on your investment time horizon. It also matters where you're coming from. Now, I think we've made a very strong case for reviewing cash holdings in the presentation today because of the impact that has over time. But when investing into equity markets, you need to take a longer term view. You need to be looking out for at least 5 years, if not 10 years, because you get a lot more certainty in terms of the returns that can be generated. So I do think it's a good time to be invested, but you have to be willing to take a longer term view within that. Of course, there's always shocks, there's unforeseen events that we can't expect. And I suppose that's another key thing that we do here at Luna as well. If we had cash that came across to be invested with us today, we don't just put it all in the market on day one. We take our time and we phase that in over time. So we were very busy in September in terms of investing into markets when they were lower, and having paused a little bit because markets had such a
a good run. So yes, it's always important to take into account what's going on in the short term. We try to do that by phasing assets in. That being said, please take a longer term view when investing, because you know, short term events can come around, as we've seen, at any time.
Yeah, thanks for that, Alex. One of the questions that I was looking to ask, and it's something I'm finding with my clients, is I think there's a difference between 2008 crisis and the 2020 COVID crisis. 2008, companies found it difficult to gear up, and so they had to recapitalise themselves, and it took a bit of time to come through. COVID, I'm finding that the companies I'm talking to, and some of our clients, are awash with money. They may have taken some of the equity out of the business. And both companies and individuals are sat on cash. And obviously with inflation increasing, but interest rates not increasing in line, they're losing money in true terms.
Yeah.
But there's still a hesitancy in terms of, is it a good time to invest? So with regards to someone like yourselves at Luna, is there a way that they can go into the market but try and mitigate some of that volatility, but at least get return that's going to keep their investments increasing in line with real returns with CPI and RPI?
Yeah, I mean, there's a very good question. I mean, we don't just invest. I mean, I've touched a lot on the equity market here, because that's what people tend to be interested in more so than anything. But we've got clients across different risk spectrums. So we've got more cautious clients that just looking to preserve their wealth and deliver returns in excess of inflation. And we also, as kind of touched on at the higher risk end, have high risk clients that want to have more exposure to equity markets. And obviously there's some that meet in the middle of that. But yes, so we have a cautious portfolio, which the returns are there to deliver around 4%. It's kind of what we expect to deliver over the long term. Where are we investing at the moment within that portfolio? Well, we do have some exposure to bonds. We quite like emerging market bonds, but short-dated emerging market bonds. So you're not taking a lot of interest rate risk with those bonds as well. Where you're still getting a return of 5 or 6%, and you're holding those bonds for a couple of years. So that, to me, seems like a good investment at this time, and kind of hits that objective of 4% for that type of portfolio. Real assets, we haven't really touched on the property market at all, but I mean, it depends where you want to look, residential, commercial, but there are opportunities within the commercial property market. You know, offices and retail, probably not so much, but there are areas that are doing very, very well and benefiting through COVID, whether it be industrial warehouses or distribution centres or data centres, which can perform very strongly in this environment. There's also a tailwind to anything green, and you can also invest in infrastructure type products, which would fit in that alternatives, where you're getting a decent yield and also the opportunity for some capital growth as well. So they would fit very well within a more cautious portfolio. And then you would have a smaller allocation to equities because of the risk and those clients wanting to have less risk. But I mean, as it's touched on, equities can help deliver over the long term as well. So yes, there are ways to mitigate and deliver good returns that beat inflation over the cycle. We're just having to look at slightly different to maybe we would have done 20 years or so ago. I mean, 20 years ago, we'd be looking at government bonds and corporate bonds. And for the reasons highlighted, we can't really hide in those areas at the moment because they're very expensive. And if anything, we feel the risks are a bit skewed to the upside at the moment. And so we're having to think about things and look for other alternatives than we would do in the past.
Good. Well, Alex, thank you. Thank you all for your time today, for dialing in. I hope you found the presentation useful. On behalf of Pareto, our clients and introducers, Alex, I'd like to thank you for your time and presenting. Just for everyone's information, the next quarterly markets and economic update will be on the 19th of January. It leaves me to wish you all a very good day. If you have any further questions or you'd like to discuss anything, feel free to speak to any of the financial advisors that you deal with personally, or come direct to myself and we'll assist you or any of your clients with any questions and queries. Lovely. Thanks again. Have a great day.
Thank you. Thank you, everyone. All the best. Bye now.